Have you ever heard the saying that big things can come in little packages? Well, in the case of the stocks we are looking at today, it is totally confirmed. Hold on to your seats, folks. This is going to be a good one. There are a lot of good stocks out there, and as the market drifts more towards the green, that may be truer than ever. However, when you look at all the big names, you are paying a lot just to get into the game. In addition, often the bigger stocks may be moving in the right direction, but they may not have that agility that you get in a smaller stock. In their defense, those big stocks do offer more safety, which is great. The smaller stocks, though, they can move fast, but without that security of a blue chip titan. So yes, they can move up fast, and well, they can also fall fast, which is that reduced safety that comes with some of the smaller stocks. Of course, doing some solid fundamental analysis can help you greatly minimize any kind of risk. Join the conversation. Let us know in the comments if you have a favorite little stock. Your participation is well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a huge thank you for that click. For today's list, we did, of course, have a few qualifiers that I used to help guide me to these little stocks. First of all, their current share price at the time of recording needed to be less than $10 and more than $1. They needed to have a positive return on equity, and I kind of just wanted to have at least a trickle of dividends on these little stocks. These stocks have a positive track record, and despite being little, they have been pumping out some very nice returns. Anyway, without any further ado, let's do this. Kicking off this list, we have Computer Modeling Group with a ticker of CMG. They are based out of Calgary, Alberta, and they are a software company that produces reservoir simulations for the oil and gas industry. It probably makes sense to be able to see how a drilling is going to go before you do the actual drilling. They have a market cap of $599.94 million, and their beta comes in at 1.20. So they're just a little bit more volatile than the market average. Their earnings per share, that comes in at 0.25, and they have a pretty high PE ratio of 30.30. Their return on equity, nice number, 39.93%, and their debt to equity ratio comes in at 72.41%. When it comes to your returns, they have a dividend yield of 2.688%. That's paid out quarterly in the amount of 5 cents per share, with a payout ratio of 83.33%. Looking at their returns, their 3-year return on investment, that comes in at 49.70%. Add in the dividends, we get a total return of 61.77%. Switching to their 1 year, their ROI comes in at 66.44% and a total return with those dividends of 70.92%. So that's not too bad. Let's take a look, of course, at 2023. So far this year, their return on investment comes in at 26.10% for a total return, once we throw in the dividends, of 27.80%. These returns are pretty darn good. The TSX has only returned 6% year to date, so this is more than 4 times the average. Following at number 4, we have Hammond Manufacturing Company with a ticker of HMM.A. They are based out of Guelph, Ontario, and they provide a wide selection of standard products and customizations, as well as technical support for electrical manufacturers and utilities. They have a market cap of $65 million, and their beta is pretty average at 1.05. Their earnings per share comes in at 1.43, and they got a nice little low PE ratio of 4.70. Their return on equity, that comes in at 17.94%, so not too shabby, and they've got a debt to equity ratio of 67.01%. On the dividend front, they have a yield of 1.047%. It is paid out semi-annually, so twice a year, 3 cents per share, and their payout ratio super low at 4.84%. When we look at their return on investment, their 3-year ROI comes in at 227.43%. Factor in some dividends and we get 236%. Not too bad. That 1-year ROI, 52.39%, total return of 53.99% after we add in dividends. So far this year in 2023, their return on investment comes in at 39.08%, and they did receive their first dividend of the year, so that takes them up to 39.81% as the total return. Earlier in the year, I invested in another Hammond stock, HPS.A, and my investment is already up over 26%. This is really a company I am beginning to love. Taking our third spot, we have Vitreous Glass Inc. with a ticker of VCI. They are based out of Airdrie, Alberta, and they are a glass recycler. They use that recycled glass to make cullet, which is then used in fiberglass insulation manufacturing. They have a market cap of $35.84 million. Their beta is a little bit less volatile than the market average at 0.72. Their earnings per share come in at 0.44, and their price to earnings ratio comes in at 15. Their return on equity is a really nice looking 54.05%, and their debt to equity ratio is teeny weeny at 2.20%. I do like that number. Their yield comes in at 13.38%. Holy banana bread, that's huge. However, here's the downside. Their dividend is only paid out once a year, so it's an annual dividend, 6 cents per share. Payout ratio is listed at 0%. A lot of times, there's a lot of difficulty trying to calculate some of these annual ones, especially when they start changing a bit. And when you look at the history of this dividend, it hasn't been a straightforward annual. It's kind of moved all over the place a little bit. Nonetheless, let's take a look at those returns. Their return on investment for the 3-year is at 69.55%, and for the dividends they've received in that 3-year period, that gives us a total return of 92.84%. When we switch over to 1 year, that return on investment comes in at 19.33%. Adding in dividends, we get 21.64%. And if we look at 2023, their return on investment so far this year is 40.59%. That's a total return of 43.32% because they did receive a dividend this year so far. Once again, with this company, we're seeing some solid returns, and this is a company that is well aligned with the current move towards sustainability, and they're poised to benefit from the increased need of insulation as construction becomes a focus as well. In our almost top spot at number 2, we have McCoy Global Inc. with a ticker of MCB. They are based out of Edmonton, Alberta, and they are a provider of equipment and technologies for, I'm pretty sure you can guess it, the energy sector. They have a market cap of $41.17 million and a pretty stable beta at 0.67. Their earnings per share comes in at 0.32, and they have a price to earnings ratio of 4.70. Their return on equity, nice looking 19.11%, and they got another good looking debt to equity ratio, which comes in at 10.04%. When it comes to their dividend, they have a yield of 2.759%. It is an annual dividend, 1 cent per share, and their payout ratio, it comes in at 0.00. And once again, it's a situation where this dividend was just recently reinstated, so it's kind of messed up with some of the data a little bit on that front. Let's take a look at their return on investment. Their 3-year ROI comes in at 271.79%. Factor in the one dividend they did get, and we got 274.36%. That 1-year ROI comes in at 31.82%. Adding in that dividend, once again, we got 32.73%. So far this year, in 2023, their return on investment comes in at 43.56% for a total return of 44.55%. So that's not too shabby. Whether energy is peaking or slumping, there is still a need for their products, and that means potential profits for their investors. In our top spot at number 1, we have Decisive Dividend Corp. With a ticker of DE, they are based out of Kelowna, British Columbia, and they are a company that likes to acquire other companies in the manufacturing sector that will complement their goals of sustainable and growing shareholder returns. Their market cap, that comes in at $112.08 million, and they have a beta of 1.05. Their earnings per share comes in at 0.37, and their PE ratio, it comes in at 20.20. Their return on equity, that comes in at 18.99%, and they do have a higher debt to equity ratio of 105.86%. I would sure love to see that one come down a little bit. When we switch over to dividends, they have a 6.218% dividend yield. That is paid out monthly in the amount of 4 cents per share, and they have a higher payout ratio at 98.65%. When we look at their returns, their 3-year return on investment comes in at 451.43%. That's a total return after we add in them dividends of 510%. Holy banana bread. When we switch to their 1-year ROI, that comes in at 77.47% for a total return of 87.13%. Looking at this year in 2023, they have a return of investment of 53.17%, a total return adding in them dividends of 57.94%. That's not too shabby at all. This is a company that fits very well into the total return strategy of investing. They have an incredible record of returns, and they have more than 9x the TSX year to date. What can I really say? These are nice looking companies, and there is a lot of return potential in this group. I just put in an after hours buy on one of them. I'll let you guys guess on which one down below. As I said, these are some swell looking stocks, and as easy as it would be to drop some dollars on them, still do your research. In today's economy, it is even more important than ever to make sure you have done your due diligence before plopping your dollars on the table. Taking our third spot, we have a Virtuous Gas. Keep the learning going. Watch my video on Berkshire Hathaway or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.